Hello traders, welcome back to ComLucro. Today we're looking at the depth of market, or DOM, a tool that reveals what is really happening behind every price move. We will cover how the DOM works, what it shows, and how it exposes the balance between buy and sell limit orders. You will learn to distinguish passive limit orders from active market orders, a skill that can instantly change the way you read the market. We will also see how the DOM reacts in real time as traders place, cancel, and adjust their orders. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. Before we get into the mechanics, let's anchor the purpose of this lesson. The DOM gives you a live view of how price forms on the chart by showing where liquidity sits and how orders interact. It is not about trading through the DOM. It is about understanding the engine that drives every candle you see. Now, let's look at the first concept you need to understand. Limit orders are passive offers. When you place an order to buy or sell only if price reaches a level you prefer, you are setting a passive order. These orders wait in the book and help shape the structure of the market, even though they do not move price on their own. If those are the passive orders, the active ones are the market orders. A market order tells the system that you want to buy or sell immediately at the best available price. These orders consume the passive limits waiting in the book. And this interaction is what physically pushes price from one level to the next on your chart. When you combine the buy and sell limit orders, you get the bid and the ask. The bid is the highest price a buyer is willing to pay, and the ask is the lowest price a seller is willing to accept. The difference between them is the spread, and it is the first space price must cross when a market order enters. The tool that displays this structure is the order book. The DOM is simply a visual way of seeing the buyers on one side and the sellers on the other, arranged by price. Even if you never trade with it, understanding its logic helps you interpret why candles accelerate, stall, reverse, or gap. To bring everything together, we have the concept of liquidity. When the order book contains large clusters of limit orders across different price levels, the market becomes more stable and harder to move. When liquidity is thin, even a moderate market order can shift price quickly and create dramatic movements that confuse beginners. These concepts form the foundation of how the depth of market explains price movement. The DOM shows the underlying mechanics that create every reaction on a chart, offering insight into why price behaves the way it does. By learning these principles, traders gain a deeper understanding of market dynamics and can interpret chart behavior with far more clarity. Now that we have a clear understanding of the basic concepts, let's delve into the specifics of how the DOM functions and how you can utilize this powerful tool to enhance your trading approach. To keep it simple, let's imagine a scenario with only a few traders in the market, and we know all their actions. The market opens at 8 a.m., and the first trader enters. He wants to buy 5 contracts at a price of 98. He doesn't want to buy immediately, so he sets a buy limit order at this price, making him a passive buyer on the DOM. His buy limit order appears on the bid side with a quantity of 5 at a price of 98. 1 minute later, another trader arrives. He wants to sell 10 contracts at the price of 99. He specifies this price with a sell limit order, making him a passive seller. His sell limit order shows up on the ask side, indicating he is asking someone to buy 10 contracts at 99 per contract. The first trader is only willing to buy at 98 or lower, so his order remains on the bid side. Now, 2 more traders enter the market. Trader 3 wants to buy 2 contracts at 97, and Trader 4 wants to sell 3 contracts at 100. These new limit orders are displayed on the DOM, but none of them match, so the price doesn't move because each trader demands a different price. At this moment, We have two buyers willing to buy at 98 and 97, and two sellers willing to sell at 99 and 100. There's no agreement between them. Let's continue. Another seller, Trader 5, wants to sell 4 contracts at 99, just like Trader 2. This increases the ask size to 14, with 10 contracts from Trader 2 and 4 from Trader 5. Still, nothing happens, but suddenly an aggressive buyer enters and says, "I don't want to wait anymore. I want to buy 5 contracts now." This aggressive buyer uses a buy market order, which doesn't specify a price. The buy market order matches with the first available sell offer, which is at 99. So this aggressive buyer purchases 5 contracts at a price of 99. By doing this, he clears 5 sell limits on the ask side at 99. This reduces the ask size at 99 from 14 to 9. All these 5 sell limits at 99 belonged to Trader 2, who came first. Therefore, Trader 2 still has 5 contracts left to sell, waiting for more aggressive buy market orders at the price of 99. There are now 9 sell limits remaining. These will be filled in the following order. First, all the remaining sell limits of Trader 2, and then those of Trader 5. It's like a queue. The limit orders are sorted chronologically, following a first-come, first-served logic. Because Trader 5 came in later than Trader 2, he must wait until Trader 2's sell limits are filled. Now, an aggressive seller enters, causing the price to move. The current price is 99 because that's the price at which the most recent trade occurred. The aggressive seller wants to sell 3 contracts using a sell market order. Remember, the sell market order pairs with the first available bid from a passive buyer. In other words, it matches with the first available buy limit order on the bid side. Where is this first available buy limit? It's at a price of 98. So the aggressive seller sends a sell market order, and the passive buyer purchases from him because the passive buyer has a buy limit at 98. The price drops to match the sell market order with this buy limit. The aggressive seller sells 3 contracts, clearing 3 buy limits at 98 out of a total of 5 buy limits at this price. Since the aggressive seller cleared 3 buy limits, 2 buy limits remain at 98. Notice that the price moved down, yet the number of sell and buy orders is equal. The price didn't decrease because there were more sellers than buyers, but because the sellers were more aggressive. Now, what needs to happen for the price to move from 98 to 97? It's simple. More aggressive sellers must clear the remaining 2 buy limits at 98. Think of it as a barrier. This barrier of limit orders must be broken for the price to move. An aggressive seller comes in and sends a sell market order to sell 3 contracts. However, at 98, there are only 2 buy limits, so this barrier isn't strong enough to satisfy the aggressive seller. So, what happens? 2 sell market orders match with 2 buy limits at 98, clearing all the buy limits at this price. With no buy limits left at 98, the market must move lower to find more buy limit orders. So it moves from 98 to 97. At 97, the remaining sell market order pairs with a new buy limit, completing the aggressive seller's order to sell 3 contracts. This aggressive seller moved the market down because his market order was paired with buy limits at 2 different prices. His sell market order for 3 contracts matched with 2 buy limits at 98 and 1 buy limit at 97. Notice this. The price moved from 98 to 97, despite there being 1 seller and 2 different buyers. However, the number of buy and sell orders is equal. A sell market order for 3 contracts and buy limits for 3 contracts in total. Now, what do you see? At the price of 98, there are no sell limit orders. Remember, a market order doesn't specify the price. The price at which the market order is filled depends only on the availability of limit orders. So, where are the first available sell limits? They are at 99. An aggressive buyer now enters wanting to buy 1 contract using a market order. The actual price is 97. There are no sell limits at 98. And the first available sell limits are at 99. Despite the actual price being 97, the aggressive buyer is filled at 99 because that's where he finds someone to buy from. He moved the market up from 97 to 99 because there was no liquidity at 98, no sell limit orders. So the market skipped this price and moved straight to 99. This is called a gap. The market gapped up from 97 to 99. The aggressive buyer experienced what's known as slippage. He bought at a worse price than he expected. He sent the buy market order when the actual price was 97, expecting to be filled at 98, because logically there should be some sell limits. In reality, there were no sell limits, so the market gapped up, and he bought at 99. This means he got a worse price and experienced slippage. So in this situation, there was one buyer and one seller, one buy market order and one sell limit order, and the price moved from 97 to 99. Now, let's look at the final situation. A big trader comes in wanting to buy 15 contracts. Meanwhile, more passive sellers have appeared and sent their limit orders into the market. The last price is 99, the price at which the most recent trade took place. This is the price the big trader sees when deciding to send his order into the market. This big trader uses a buy market order to purchase 15 contracts. By doing this, he moves the price from 99 to 103. You can see how his market order for 15 contracts was paired. Take a moment to observe this. There was one buyer and many sellers, and the price moved by 4 points. However, the quantity of buy and sell orders was equal. 15 contracts to buy and 15 contracts to sell. This is always equal, and this is how the price moves. However, in reality, such a big trader is likely to use a limit order to open a trade because he trades such large positions that the potential slippage when using market orders is significant. To sum it up, the price moves in relation to market orders and available limit orders. These limit orders act like a barrier. When this barrier is not strong enough to satisfy market orders, the price moves. However, the number of buy and sell orders is always equal. For example, in this last scenario, the price moved from 99 to 103 with 15 buy market orders and 15 sell limit orders. In conclusion, understanding the depth of market, DOM, is essential for any trader looking to gain insights into market dynamics and price movements. The DOM provides a detailed view of limit orders and market liquidity, helping traders identify potential support and resistance levels. By distinguishing between passive order flow, limit orders, and active order flow, market orders, traders can make more informed decisions and improve their trading strategies. By analyzing the DOM, traders can better understand how prices move in response to the interaction between buy and sell orders. This knowledge enables traders to anticipate market movements and adjust their strategies accordingly. Remember, the key to successful trading lies in understanding the mechanics of the market and using tools like the DOM to gain a competitive edge. Before we wrap up this analysis, notice how the depth of market becomes far easier to understand when you see how limit orders, market orders, and liquidity barriers interact to create every price movement. Throughout this walkthrough, we saw how passive and active order flow shape the bid, the ask, the spread, and ultimately the direction the market prints on your chart. But understanding how price moves is only part of the equation. The real challenge is recognizing why certain pockets of liquidity create stronger reactions while others are cleared with ease. To make this even clearer, I am going to play a short clip that shifts our focus from market mechanics to trader behavior. The DOM shows how price responds to order flow, but this clip will show how you respond to emotional triggers that appear long before you place a trade. When you combine mechanical clarity with emotional awareness, your decision-making becomes far more stable. Let's take a look. Many traders believe they lose control only at the moment they click buy or sell, but the real loss of control starts much earlier. It begins with small emotional triggers that activate old patterns before you even notice what's happening. A single comment from someone at home, a missed entry, a sudden spike on the chart, even checking your P&L too soon. These micro events can silently shift your state and shape the decisions you make minutes later. These triggers matter because trading is not just about reading structure. It's about reading yourself. When a trigger hits, your mind narrows, your patience drops, and your perception of opportunity changes. You start seeing urgency where there is none, or danger where there's only normal volatility. Without awareness, these reactions feel automatic, and they push you into trades that do not match your plan. Most traders think their mistakes come from lack of discipline, but in reality, they come from unrecognized triggers that speed up the decision process. A small frustration turns into a rushed entry. A brief moment of excitement becomes oversized risk. A tiny fear becomes hesitation that costs you the setup. The chain reaction is fast, and once it starts, it is very hard to interrupt without a clear map of your triggers. That clip reinforces a core principle that connects directly with everything we covered about the depth of market. The DOM reveals how aggressive and passive orders move price, but your ability to act on that information depends on how stable your internal state is. When you recognize your emotional triggers early, you avoid the impulsive reactions that lead to poor entries, premature exits, or unnecessary risk. Traders who combine a clear understanding of order flow with strong emotional awareness make sharper decisions and avoid the mistakes driven by pressure and reactivity. With mechanical insight and psychological stability working together, your execution becomes more consistent, more intentional, and far more aligned with the true dynamics of the market. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.